Hello everyone, welcome to my channel hdorionn. We are studying accountancy for class 12th from T.S. Grewal's textbook 2023 edition, Accounting for Partnership Firms. Chapter 3, Change in Profit Sharing Ratio Among Existing Partners. And in this video, we will study revaluation of assets and reassessment of liabilities. So let us see some questions from the textbook. So when there is change in the constitution of a firm, like change in profit sharing ratio among partners, or admission of a partner, or retirement of a partner, or death of a partner, it is time for the firm to revalue its assets and liabilities. Where are these assets and liabilities stated? They are stated in the balance sheet. So the balance sheet assets and liabilities are revalued as per the current situation, and whatever the partners agree on, these revalued values are taken into consideration. For that, a revaluation account is prepared. There can be either increase or decrease in the value of assets and liabilities. Not necessarily, but some of the assets and liabilities values will definitely increase or decrease, resulting in gain or loss arising from it. And this gain or loss is transferred to the partner's capital account because they belong to partners and old partners, and it will be shared to the partners in their old profit sharing ratio because these assets and liabilities are from the old balance sheet, because the new profit sharing ratio is to start from this day, and therefore till previous day, which reflects the balance sheet, is related to old profit sharing ratio. So partners will share this gain or loss arising from revaluation of assets and reassessment of liabilities in their old profit sharing ratio. So partners may decide to record revised changed value of assets and liabilities in the books of the firm, or not to record the revised or changed value of assets and liabilities in the books of the firm. Now it depends on partners' opinion whether they want to record the revised change in the new balance sheet or not. Fine. In both the ways, the approach is different, a little different, and we will see this when we are solving the questions from the textbook. Now, this is the specimen of revaluation account. It is very simple and very easy to understand this account. See, on the debit side, whatever is recorded here is to assets individually, assets to individual liabilities, to unrecorded liabilities, to partners capital account for remuneration, cash or bank for expenses, and to the credit side there is assets individually we have to record, liabilities also individually, unrecorded assets, and out of these two effects either there will be gain or there will be profit, there will be loss. So either if it is loss or gain, whatever, it will be transferred to partner's capital account in case capital account is fluctuating, and it will be transferred to partner's current account in case capital account is fixed. So looking at this specimen, it looks like it is very difficult to understand what is happening here. So to cut it short, I can tell you that if there is increase in the value of assets, you have to record it on the credit side of revaluation account, or if there is decrease in the value of liabilities. So in both the cases, you have to record it in the credit side of revaluation account with the difference in amount, not the final amount or the initial amount, but the difference with which the assets has increased or the liabilities has decreased. And reverse is the case on the debit side. In this side, we will record decrease in the value of assets or increase in the value of liabilities. Here also the difference amount, not the initial or the final amount, but the amount with which the assets has decreased or liabilities has increased. So unless we solve the questions, it won't be very easy to understand it. So let us take help of the questions given in the exercise. But let me remind you, when the assets are increasing or liabilities are decreasing, that will be debited and revaluation account will be credited. And when assets are decreasing and liabilities are increasing, in that case, the journal entry will be revaluation account debited to respective asset or liability. So that is very, very simple. You just have to remember this and the things are done. Question number 25. Ashish, Akash and Amit are partners sharing profits and losses equally. The balance sheet as at 31st March 2023 was as follows. So here is the balance sheet given. To the liability side, we have sundry creditors, general reserve and capitals of the partners. And to the asset side, we have got cash in hand, cash at bank, sundry debtors, stock, land and building, machinery and advertisement suspense. Here in the balance sheet, we see advertisement suspense. It always appears on the asset side and reserves are always on the liabilities side. Now, the question further says the partners decide to share profits in the ratio of 2:2:1. That is, it is a question of change in profit sharing ratio among partners. And now this gives us a chance to re-evaluate or revalue our assets and liabilities. And this change is with effect in force from 1st April 2023. They also decided that value of stock to be reduced to rupees 1,25,000. You see, stock is 1,40,000. From 1,40,000 we have to bring it down to rupees 1,25,000. It means 15,000 less. Value of machinery to be decreased by 10%. So machinery 10% it will decrease. It means by 25,000 rupees. Third point, land and building to be appreciated by rupees 62,000. Appreciated by rupees 62,000. Land and building is rupees 4 lakh given here and it has to increase. We have to increase it by rupees 62,000. So in the first point and in the third point, the preposition to and by are very much to understand, because here it has to reduce to and here it is appreciated by. So appreciated by means this much we have to add, and reduced to means we have to bring down to this amount. Right? From rupees 1,40,000 we have to bring down. This is the lower limit, or say the price at which it is evaluated. It is valued. Provision for doubtful debts to be made at the rate of 5% on sundry debtors. Akash was to carry out reconstitution of the firm at a remuneration of rupees 10,000. So because Akash is a partner and he is given the responsibility of reconstituting the firm, for this he will be paid a remuneration of rupees 10,000 by the firm. Pass necessary journal entries to give effect to the above. So let us see the journal entries for this. So the first entry is the value of stock to be reduced to rupees 1,25,000. Right? And second point says value of machinery to be decreased by 10%. Means both are assets and both are decreasing. Fine. So revaluation account debited. To stock and to machinery. Stock is decreasing from 1,40,000. It is coming down to rupees 1,25,000, and machinery is decreasing by 10%. So what is the value of machinery in the balance sheet? It is 2,50,000 and 10% of which is rupees 25,000, and here it is 15,000. So revaluation account is debited. When it is debited? When the assets are decreasing or liabilities are increasing. So these two cases are decrease in asset, and therefore revaluation account is debited with this amount, and it is 40,000 rupees, being decrease in the value of asset. Then third point says uh, land and building to be appreciated by rupees 62,000. So land and building are assets, so debited land and building. When an asset increases, it has to be debited to revaluation account by rupees 62,000. So it is 62,000, being increase in asset. Then fourth point says provision for bad and doubtful debts is to be made at the rate of 5% on debtors. So that what is provision? Provision for anything is a liability. So it is increase in liability. For that, revaluation account debited. Revaluation account debited to provision for bad debts. So revaluation account is debited when there is decrease in asset or increase in liabilities, and provision for bad debts is a liability. Here revaluation account is credited when there is increase in asset or decrease in liability. So this land and building is an asset and it is increasing. And provision for bad debts is to be maintained at 5% of debtors. How many debtors? 80,000 rupees is the debtor given in the balance sheet, and 5% of which is rupees 4,000. Being provision for bad debts made. Then fifth point says Akash was to carry out reconstitution of the firm at a remuneration of rupees 10,000. So Akash is one of the partner, and when you are paying Akash, it means what? Your cash will be decreased, but Akash is a partner, so instead of paying him in cash, we will increase his capital account. So revaluation account debited to Akash capital. Akash capital rupees 10,000. Being remuneration to partner. Now we have to calculate profit or loss on revaluation. See the first entry here. Revaluation account is debited by rupees 40,000. Then again revaluation account is debited by rupees 4,000. So 40,000 plus 4,000 is 44,000. And then in the last entry again revaluation account is debited by rupees 10,000. It means 40 plus 4 plus 10, it is 54,000. So to the debit it is how much? 54,000. And see the liability side, credit side. In the first entry there isn't any. In the second entry revaluation account is credited for 62,000. So when we compare it with 62,000 rupees, so debit we are having this much and credit we are having 62,000 rupees. It means there is 8,000 rupees short on the debit side to make it equal 62. So this is what, when the adjustment is done on the debit side, it means when the credit balance is there, it means it is a profit. So this 8,000 rupees will be recorded as profit for the partners. So revaluation account debited with rupees 8,000 to all the three partners: Ashish capital account, to Akash, and to Amit. and this will be given to the partners in their old profit sharing ratio, and it is how much? Equally. So 8,000 rupees will be given to the partners equally, all the three partners equally. So it is how much? 2666, 2667 and 2667. So that way the profit will be distributed to the partners. Now let us see question number 26. Hari, Kunal and Uma are partners in a firm sharing profits and losses in the ratio of 5:3:2. From 1st April 2018, they decided to share future profits and losses in the ratio of 2:5:3. That is, there is a change in the profit sharing ratio. Their balance sheet showed a balance of rupees 75,000 in the book in the profit and loss account, and a balance of rupees 15,000 in investment fluctuation fund. For this purpose, it was agreed that now their balance sheet showed a balance of rupees 75,000 in the profit and loss account. Now here it is not clear about whether it is a profit or loss, whether it is a credit balance or a debit balance. So we have to take it as credit balance, take it as profit. Fine. So this is a profit. We have to take it, because when it is a loss, then definitely the question will mention this. But if it is not mentioned, then we have to take it as profit. It means it is a credit balance. And for this purpose, it was agreed that goodwill of the firm was valued at rupees 3 lakh, because there is change in profit sharing ratio and therefore goodwill has to be calculated. The investments having book value of rupees 50,000 were valued at rupees 35,000, and the stock having a value of rupees 50,000 be depreciated by 10%. Pass the necessary journal entries for the above in the books of the firm. So let us see the explanation of it in the solution. Solution 26. Let us see the second and the third points. That is, investments are decreased. So whenever assets are decreased, revaluation account is to be debited. Revaluation account debited. When it is debited? When assets are decreasing or liabilities are increasing. In our case, investments are decreasing. So to investments. But here, for decrease in the value of investment, there is investment fluctuation fund and it will be compensated from here, and therefore we will not record it in revaluation account. Please understand this, that when investment fluctuation fund is there, then the decrease in the value of investment will be adjusted through investment fluctuation fund and it will not be recorded in revaluation account. But the other part, that is stock, when there is a decrease in stock, so to stock, when it is decreasing by 10% of 50,000, so this 5,000 will be recorded, being decrease in assets, being decrease in the value of assets. Now no other information for revaluation account is there, so the revaluation account is showing a debit balance. You see, only debit is there. It will be transferred to partners capital account. It is a loss on revaluation. So Hari, Kunal and Uma will receive this loss. Hari's capital account debited, Kunal's capital account debited, and Uma to revaluation account. Rupees 5,000 in their old profit sharing ratio, which is 5:3:2. So 2,500, 1,500 and 1,000. Now let us close investment fluctuation fund. So investment fluctuation fund, not fund, it is yeah, it is written fund here, reserve it is. to investment. It is 15,000 rupees. The value of investments have decreased by 50,000 and it is adjusted by investment fluctuation reserve being decreased in the value of investment. Now for the treatment of goodwill, we have to compare old ratio, which is 5:3:2, with new ratio, which is 2:5:3 for the partners. So for Hari, because we know that sacrificing ratio is equal to old ratio minus new ratio, and goodwill is treated in sacrificing and gaining ratio. So let us calculate for Hari. It is 5/10 minus, it is how much? 2/10. So the answer is 3/10 and it is in positive, so Hari has sacrificed. Okay, then the other partner Kunal. Kunal's portion is 3/10 minus 5/10, that is equal to minus 2/10. So he has gained because the answer is in negative. And then last partner Uma. Old ratio is 2/10 minus 3/10, that is equal to minus 1/10. So Uma has also gained. Sacrifice 3 and gain is also 2 plus 1, it is 3, because the denominators are same. You have to check that, fine, in order to see that sacrifice is equal to gain. And we know that the partner who sacrificed, his capital account is to be credited, that is increased, and the partner who has gained, capital account has to be debited. So this will be the journal entry for treatment of goodwill. So the journal entry for goodwill will be gainers capital account debited. So who are the gainers? Kunal. Kunal's capital account debited. Uma also has gained. Uma's capital account debited. To sacrificer, that is Hari. Hari's capital account. And total goodwill of the firm is rupees 3 lakh. And we have to multiply it with their portion of sacrifice or gain. So Kunal has gained 2/10. So it is 60,000 rupees. And Uma has gained 1/10 of the total profit. So it is 30,000 rupees. And Hari has sacrificed 3/10 of the total profit. So it is 90,000. So this is the treatment of goodwill. Being treatment of goodwill. Now in the question, there is given profit and loss credit balance also. So we will debit it and close it. So profit and loss account debited. And the amount here is 75,000 rupees and it will be transferred to partner's capital account. So the amount is rupees 37,500, rupees 22,500 and rupees 15,000 for the partners. So this is how the question is to be solved. Now let us see question number 27. A, B and C are sharing profits and losses in the ratio of 2:2:1. They decide to share profit with effect in force 1st April 2023 in the ratio of 5:3:2. They also decided not to change the value of assets and liabilities in the books of account. Now this is a very important line here. They not to change the value of assets and liabilities in the books of account. The book value and revised value of assets and liabilities as on the date of change were as follows. Because the profit sharing ratio is changing and therefore the assets and liabilities are revalued. So the book value and the revised value is given here in the question. Machinery, its book value was rupees 2,50,000 and now it is valued as rupees 3 lakh. Computers, from 2 lakh to 1,75,000. Sundry creditors 90,000 to 75,000. Outstanding expenses rupees 15,000 to 25,000. Pass an adjustment entry. Now here an adjustment entry is required because of this statement, not to change the value of assets and liabilities in the books. So when such statement is there, then only one adjustment entry will be passed. And in this question, we will have to calculate sacrificing and gaining ratio of the partners also. Solution 27. There are three partners A, B and C, and their ratio is 2:2:1. This is the old ratio. And new ratio is 5:3:2 is the new ratio. Because we cannot change the values of assets and liabilities, and therefore we have to calculate sacrificing or gaining ratio. We know that sacrificing ratio is equal to old ratio minus new ratio. So we will calculate it for partners A first. Old ratio is 2/5. Here 2/5 minus 5/10. When you hit LCM is 10. And in the numerator you will get 4 minus 5, that is equal to minus 1/10. So a sacrificing ratio is in negative, it means it is gain. And for B, it is 2/5 again here, minus 3/10. LCM will again be 10, then 4 minus 3, that is equal to 1/10. So it is positive, therefore it is sacrificed. Fine. And for partner C, what is it? 1/5 minus 2/10. Here also LCM is 10, and in the numerator we get 2 minus 2, that is nil, that is 0. It means only A is gaining from B, and therefore the person or the partner who gains, capital account has to be debited, and sacrificer's capital account is to be credited. But what is to be debited and credited? It is the revaluation of assets and liabilities. Let us see what is the result of that. So this is what is given in the question regarding book value and revised value of various assets and liabilities. So we will compare this and find out whether it is a gain or it's a loss for the firm. So here from 2,50,000 rupees, the revised value of machinery is 3 lakh. So it is a gain of 50,000. You understand what gain is. You see, when the assets are increasing, it's a gain. So it is gain for the firm. Computers are decreasing by 25,000. So it is a loss, 25,000. So we will write it in bracket so that it can be cancelled against each other. So it is a loss. Sundry creditors from 90,000, it has decreased to 75,000. So 15,000 rupees has decreased, and it is a gain. Of course, it is a liability, but decrease in liability is a gain for the firm. So 15,000 rupees gain. Gain it is. And then outstanding expenses has increased. So when a liability increases, it is a burden. It's a loss. So 10,000 rupees is loss. Now, when you add this, you get positive 30,000 rupees. It means in this reevaluation, there is a gain to the firm by rupees 30,000. And we have to make an adjustment entry taking rupees 30,000 gain as base. So let us pass the journal adjustment entry. So the journal entry is A's capital account debited. It is 30,000 rupees, and A has gained 1/10 in the total profit of the firm due to change in profit sharing ratio among partners. So 3,000 rupees. And who has sacrificed this? B's capital account. B has sacrificed with the same amount, rupees 3,000. So B's capital account is increased and A's capital account is decreased. So B has received this 3,000 rupees from A's capital account, being adjustment entry passed. So this adjustment entry is passed because of a statement written in the question. Let's see the second line. It says they also decided not to change the values of assets and liabilities in the books of account. Due to this statement, this adjustment entry and these all calculations are made. Otherwise, the question was supposed to be solved by opening a revaluation account, as we have seen in the previous question. Now, let us see question number 28. Ajit, Vijit and Sujit are partners in a firm, sharing profits and losses in the ratio of 5:3:2. They decided to share profits and losses in the ratio of 2:5:3 with effect from 1st April 2023. Land having book value of rupees 1 lakh was found undervalued by rupees 2,50,000, and stock having a book value of rupees 4 lakh was found overvalued by rupees 3 lakh. Pass the necessary adjusting entry without affecting the existing book value. Now, because of this, without affecting the existing book value, we have to make an adjustment entry by calculating sacrificing and gaining ratio of the partners and give effect to the change in assets, change in the value of assets and liabilities. Just like previous question, question number 27. So solution 28 we will see. 28, there are three partners and their old ratio is 5:3:2. This is their old ratio. And their new ratio is 2:5:3. This is the new ratio. Now let us calculate sacrificing ratio. That is old ratio minus new ratio for partner Ajit. Old ratio is 5/10 and new ratio is 2/10. It is a sacrifice of 3/10 of the total profit sacrifice. And Vijit old ratio is 3/10 minus new ratio is 5/10. So it is what? Minus 2/10. So it is a gain of 2/10 of the total profit of the firm. And Sujit is 2/10 minus 3/10, and the result is minus 1/10. Here also gain. So here you can see the sacrifice is equal to the gain. So sacrificer's capital account is to be credited and gainer's capital account is to be debited and reduced. But what amount? What is the amount that we have to calculate? Land, you see, let us calculate it here only. Land, the book value was how much? The book value was rupees 1 lakh and was found undervalued by rupees 2,50,000. So book value is rupees 1 lakh, which is undervalued by rupees 2,50,000. Actually, the land was supposed to be for rupees 3,50,000 and it is shown in the books at rupees 1 lakh. So we have to increase the value of land by rupees 2,50,000. So this is a gain for the firm. And stock is shown at rupees 4 lakh and it is overvalued by rupees 3 lakh. So we will reduce the value of stock by 3 lakh and its actual value to be shown in the books is rupees 1 lakh. So this is the portion where the firm has gained or firm has lost. So the effect of this is there is a loss of rupees 50,000. Fine. Land worth rupees 3,50,000 was shown in the books for rupees 1 lakh. So it was 2,50,000 less. So when you are increasing the value of asset, so it is a gain for the firm. And stock, instead of showing it at rupees 1 lakh, was recorded as rupees 4 lakh, which was overvalued by rupees 3 lakh. So we have to decrease the value of stock and we have to increase the value of land. The effect of this is a loss of rupees 50,000. This is what the revaluation of assets and liabilities, the result is. And now we will multiply it with gaining and sacrificing to pass the journal entry. But because it is a loss, this condition of debiting and crediting will be reversed. Now Ajit's account will be debited and Vijit's account will be credited and Sujit's account will also be credited. So journal entry will be Ajit's capital account debited. The loss is of rupees 50,000 and multiplied by 3/10. That is the portion sacrificed. To Vijit, capital account 50,000 into 2/10 gained, and to Sujit, capital account 50,000 into 1/10. So it is 15,000, here 10,000 and here 5,000. Being adjustment entry passed. So this is the answer. Now let us see question number 29. Rajesh and Mahesh are partners in a firm sharing profits in the ratio of 3:2. Their balance sheet as at 31st March 2023 was as follows. To the liabilities side, Rajesh capital and Mahesh capital is given and creditors of rupees 36,000 is given. And to the asset side, there is cash, machinery and building. Now, goodwill of the firm is valued at rupees 36,000 because it is a question of reconstitution and therefore goodwill is evaluated. And the building of at rupees 90,000, whereas building is here 72,000, it is now revalued at rupees 90,000 on 31st March 2023. The partners decide to share profits equally with effect from 1st April 2023. Pass the necessary accounting entries without affecting the existing figure of building. So here also we see that we have to make the treatment for change in the value of building without affecting the value of goodwill in the balance sheet. Means the value of building in the balance sheet will remain the same, but the effect of it should be given to the partners. So solution 29, there are two partners, Rajesh and Mahesh, and their old ratio is 3:2 and 1:1 is the new ratio. Now we will calculate sacrificing or gaining ratio. So for Rajesh, old ratio is 3/5 and new ratio is 1/2. So LCM is 10, 6 minus 5, that is equal to 1/10, and it is sacrificed. Means Rajesh has sacrificed 1/10 of the total profit to the other partner, Mahesh. Is equal to 2/5 minus 1/2. So LCM is 10, 4 minus 5, that is equal to minus 1/10. So it is gain. Now let us make journal entries for goodwill. So sacrifice means capital account is to be credited and gain means capital account is to be debited. For treatment of goodwill, Mahesh capital account will be debited to sacrificer Rajesh, and total goodwill of the firm is rupees 36,000. So multiplied by the portion they have gained or sacrificed, 1/10. So here it is 3600 being treatment of goodwill. Being treatment of goodwill. Now see, for revaluation of assets and liabilities, there is only one asset whose value is increased. has increased. So building. In the books, now it is valued at rupees 90,000 and its book value is rupees 72,000 as given in the balance sheet. So this is the book value and this is the revised value. So there is an increase of 18,000 rupees, which is a gain to the firm. So this and journal entry for this we have to make, because the firm doesn't want to change the value of goodwill in the books. The firm wants that in the book the value of building should remain 72,000, not 90,000. But the benefit of this 18,000 should be given to the partners. So here also adjustment entry has to be passed, and so the same journal entry with different amount. Mahesh capital account debited to sacrificer Rajesh. So 18,000 rupees multiplied by portion 1/10 portion of total profit which Rajesh has sacrificed and Mahesh has gained. It is 1800. So this way the solution is to be made. I believe that you have watched the full video and have listened the explanation given in the video very carefully. In case you are having any doubt, then please put it in the comment section. Thank you so much for liking, subscribing and sharing this channel. Thank you so much for watching this video.